From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, October 15th, and you're listening to the HPS Macrocast. I'm Brian DeAngelis, subbing in for Tony Fratto this week, and I'm here with Brendan Walsh, our co-host from Market Policy Partners. And we're joined once again by our good friend, John Dick of CivicScience. John, great to have you back on the show.
Awesome to be here.
John, we work together on a bi-weekly economic sentiment index, and we came out this week. It was another big drop. We continue to see the ESI. It was actually the second lowest reading, I think, in ESI history, behind March 2020, and we all know what went down then. And as we were just discussing, some pretty big drops on some of the indicators themselves. So maybe I can start with you. Tell us what's going on and what we're seeing from consumers on that front.
Yeah, I mean, well, first of all, just a little small correction. It's actually a daily economic sentiment index. We just publish it every 2 weeks.
Correct. Yes. Thank you.
And I mentioned that only because like it's that granularity that we're seeing is important. Yeah. I mean, it is a hot mess right now. There's no other way to put. I think that's what Milton Friedman would have called it. But I mean, I don't recall, and I would have to go back and look even in March of 2020 if all 5 of the key indicators dropped, and I don't think any of them dropped, or at least all 5 of them dropped to the extent that they did. We had even when we've had bad readings over the last year or so. Views of the job market always sort of buoyed things a bit, right? Because once we kind of got through the earlier phases of COVID and the job market started heating up and getting in this frothy place, it was people always felt like it was still a good time to go out and look for a job. So for that one always sort of bolstered the number just a little bit. For that one to go down along with all the others was also really surprising.
Yeah, and let me just jump in for a sec for our listeners. So all 5 is confidence in finding a new job, confidence in making a major purchase, confidence in personal finances, the housing market, and then overall the U.S. economy. So you were saying all 5 dropped this week, which I think is pretty rare for us, if ever.
Yeah, I mean, I at least not to this extreme sort of like each of them that dropping that much. Again, there's always sort of maybe been one that like even pre-COVID, like the housing market views were pretty positive, even when the others were negative. But this was like universally across the board. And look. What we know is these are survey questions asked to the average consumer, right? They're not intellectualizing each of these things, right? It's as much of an expression of like their hopes and fears as it is like their deep understanding of economics, right? We know that. Right. So what this tells us is that people are particularly fearful right this minute. And that shows up probably no more with no higher fidelity than it does in the question that we ask about people's outlook for the U.S. economy. And I think the way we ask the question is, do you believe the economy is going to get better or worse over the next 6 months, essentially, and sort of much better, much worse, and so forth. That is the indicator that dropped the most this week, right? And again, I'm pretty sure it's the most we've ever seen it drop in a 2-week reading. So people, it's not just so much that, hey, I feel right now is bad. Like I'm worried right now about my personal finances. I'm worried about being able to make a major purchase coming into the holidays. But like, I don't necessarily feel like there's a light at the end of the tunnel that I can see. You know, one of the things just, you know, from my own personal interest in this conversation, I want to ask Brendan is like, when we first started talking about inflation, and we'll spend some more, I want to come back to inflation, at least from the consumer's perspective in a minute, and what the implications of those fears are. But as it relates to that outlook, I was really eager to ask Brendan, like when we first started talking about inflation in April, I guess it was at least when I was on this podcast with you all, that word transitory was used pretty freely. Like it was, everyone's like, hey, it's just, you know, point in time stuff. It's these weird circumstances. Right. Is that still the general economic consensus, and what does transitory mean? I mean, it's a word that the average consumer doesn't certainly understand, but I'd love to know like what's the kind of prevailing theory on that at the moment.
Yeah, so the Fed's take is still that it's transitory, but the underlying data is making it seem like that transitory period is going to be a little longer than we thought. So we got the CPI reading on Wednesday, and the headline number, which includes food and gas and energy prices, was 5.4% on a yearly basis. It was also like 0.5% on a monthly basis. that was heavily driven by both the cost of gas, which has really gone up a lot. Oil is now over 80%, $80 a barrel. That really has more to do with supply. It actually really doesn't have to do with oil. It has to do with the cost of natural gas in Europe, which is at a shortage. So there's fears that people will there'll be huge gas shortage, so people will switch to oil for the winter heating season. In America, we have enough energy because we actually are a huge energy producer at now. But it does mean we're going to continue to see over $3, $3.50 a barrel at the gas pump. Food prices are also going up. That has to do with a lot with the cost of shipping, which we saw the president, out in LA trying to fix the 70 boats that are sitting there waiting to be unloaded. There are things that are just taking longer to fix than we thought, and it has entirely to do with hiring people. It's just very difficult to hire people right now. There's over 7 million jobs open. We get the JOLTS, the jobs, the jobs openings and labor turnover survey, and people would do PhD dissertations on this, so I don't know exactly what's happening, but because of COVID, people are less willing to go back to, I don't know, quote unquote, crappy jobs, And a lot of those crappy jobs are working in restaurants, driving a truck, and especially working in warehouses. So
tell us more about that side of it. Like, I'm curious. The supply chain problems are coming down to, in part, right, truckers and warehouse workers, and Biden's pushing for 24/7.
The average age of a trucker is over 50 years old. So for basically every 100 truckers you can hire, 80 retire. So every day we're losing, 20% of the trucking force. And while the Biden administration wants to, do 24/7 at the ports and have truckers drive at night, that's a wonderful concept, but you have to convince people to work to drive at night. It's also a lot harder to drive at night than it is in the day. So it's almost more a psychological, sociological answer than it is an economic one.
Right.
We could get out of this if people went back to work and we kind of returned to normal, but that's not the case. And I think that's worrying the Fed. Yeah. The other component, this is more of a quirk of how we measure inflation. We measure inflation, the housing component of it. It's not how much your house is worth, which your house prices have doubled in the pandemic. But it's how much you can rent your house for. So rental prices went down a massive amount in the pandemic because everyone moved out of cities, and we heavily weight the city component of rental over the suburbs. Now people are moving back, so rental prices are going up. So it's a 6-month moving average, so it is a slow moving thing. But in the latest CPI component, while core was only up 2%, a lot of that had to do with the cost of used cars went up 100%. Now it's normalizing, so it's coming down. So it dragged, but that's going to end fairly soon. But housing is starting to go up. It was up 0.3. So it's 20% of the core PCE and 40% of core CPI, and that's a sticky number. So the actual components of the inflation numbers that we use are going to be above 2% on an annualized rate. The Fed wants
for significant. They
don't want to go back to 1.5 to 2% that they were in. They want to do the 2.5. But I guess the point is you're going to have all this noise based around supply shortages, which is a labor issue, but that then seeps into the CPI. Yeah. So the Fed's hands could be tied a little bit in the next, say 3 to 9 months, as inflation still remains well above their target, because we're not going back to normal as quickly as we thought we were.
Well, let me kick it back to John, because I want to.
I was going to grab it anyway.
Yeah. There's 2 points there. One is, I think back to normal, we are seeing some demand, right? Retail sales are up, credit card spending is up, consumers are out there. But I think we're all hearing from, our mom or grandma that like, get your Christmas shopping done now because nothing's going to be on the shelves. They can't get anything. How much is this real, John? How much of it is noise?
Oh, it's real. I mean, we are seeing holiday retail planning for the holidays and holiday shopping starting as early as I've seen it in the years that we've tracked it. And it is, and you ask the consumer, why are you starting early? They're saying, because I'm worried that if I don't, the things I want to buy aren't going to be available to me later. Or they think they're only going to get more expensive as we get closer to the end of the year. So that is 100% happening. I still expect a bonkers holiday retail season, total aggregate spending in retail, or not just retail, but holiday spending in general.
Right.
Because we know, despite all these fears and concerns for the future, like the average U.S. consumer is sitting on piles of money that, more than they had before the pandemic started. Now, we know that's not everyone. There's, 20% of the country that are financially far worse off. I want to go back really quickly to add a wrinkle to the labor conversation, because this isn't necessarily an economic observation, but it has economic consequences. Really fascinating thing we track. Again, this is a daily survey. We're running thousands of different questions, but one of the things we've tracked for a long time is asking consumers to sort of weigh the value of money versus the value of time, right? So which of these two things do you value more or less? And, most people like to say they value time over money, right? And so it's always skewed in that direction, but it's become increasingly skewed in that direction since the pandemic, the heart of the pandemic. And other ways we see that manifest is when we ask people, like, would you be willing to take a job making slightly less money if you had more free time and flexibility in your life? That stuff has been skyrocketing. Why? Because we got a taste of what that was like last year, right? Yeah. People realized,
enjoyed it.
Oh, yeah. Oh my gosh, my life is so much better. And, because there were so many categories we weren't spending in last year that some travel and travel ball tournaments for our kids and all this sort of stuff, and dry cleaning and whatever else it might be. It's like, well, I kind of didn't even miss a lot of those things so now it's like, I thought I needed all this money to spend on all these things that I really like to do. But in reality, I far more enjoyed having more free time. And I don't really need some of those things that I was spending all that money on before COVID. What does all that mean? That means that it's not just as simple as if you pay people more money, they'll come back to work, right? Yeah. Americans have made a huge upheaval in value judgments. And so this question of, if you think about a trucker, I mean, how often they're away from their families in those trucks, right? That's just, it might not just be about paying them more. It's just no, I don't want to go back to that. So I don't know what the near term or long, I don't know what.
No, I know. At all is and also the big box like the Amazons and the Walmarts, they've had to pay people a lot more. Like Amazon's paying $18 an hour now. So that resets the bar for every business within that community.
100%.
So it's a good thing, but it's also, it's kind of ironic. It's a bad thing for the small businesses, because now, as a restaurant, you got to pay people a lot more to attract them to come spend 8 hours on their feet, for no benefits and tips, when you could go to Amazon for 8 hours on your feet, but you get full benefits,
Yeah. The other dimension of this is, of course, just sort of the political nature of it, that when we ask these questions of the average consumer, their hopes and fears are so heavily correlated to which side of the political aisle they're on and whether they have faith or not in the political leadership of the day to fix the problem. Right. And if we cross tabulate even our ESI questions with political party affiliation, which we can do, you see very different answers. And it's not because Republicans are generally far more pessimistic and sour about things today, not necessarily because Republicans have felt the burden of this more than Democrats, but simply because they don't have a lot of confidence in the Biden administration to fix it. And they point the blame at the Biden administration. We all know that gas prices have almost nothing to do with anything that happens in the White House, right? Right. It's a global supply, global price problem, but the average consumer doesn't. They want to just blame whoever's in office when they see gas prices go up. And that's driving a lot of irrational reactions to the ESI. Sorry.
Sorry, I'm curious where Democrats are on that, if you know, because I look at our ESI, right? And as you mentioned earlier, it is sort of that 6-month view. And if you're the Biden administration and consumers, have this pessimistic view of where we're going to be in 6 months, I get really worried about midterms and everything else I'm planning.
Yeah, well, the Biden administration sent one of their senior advisors, Sullivan, to Saudi Arabia, who do not have good relations with Saudi Arabia. Right. So that was entirely to essentially beg
gas prices
them to increase production. And OPEC kind of gave them a FU, and they kept with the 400,000 increase, which was already pre-planned. So it's not working. And the Biden administration realized gas prices are a big deal. The two kind of things they predict, consumer sentiment are the stock market and gas prices. And stock market's still fine, but gas prices are up a lot.
Right.
Well, right. I mean, I know traditionally that's true, and it probably will be true for the rest of mankind as long as we're putting gas in our cars. But the third factor right now, and I really believe it's why the ESI has been down as badly as it's been down, is because you've got two things. You've got when we ask Republicans how they feel about the economy, their answer is, well, it's a mess because of Biden, and Biden can't fix it. When you ask Democrats about their outlook for the economy, it's because COVID isn't going away, right?
Yeah.
And so you've got their fear is like, and they're blaming what they believe to be the center right people who aren't getting vaccinated, and they don't don't see anything on the horizon that's going to tell them that 20+% of Americans who've abjectly rejected vaccines are ever going to get vaccinated. So we've seen this from the beginning. I mean, the ESI during COVID pretty much has tracked to a T concerns about COVID, right? When things started getting better in the summer, ESI went up. And then as soon as the Delta came up, the ESI went down. And right now we're just in this stuck in this place where you've got both parties are really kind of, disappointed for different reasons
I think I put it out
so
on
encouragingly. I mean, it's sad. We lost 300,000 people. We didn't need to, but Delta is so contagious that in the South and the places that have very low vaccine rates, the infection rate has plunged in the last week, and it's basically back to the lowest levels in Louisiana and Florida. And I mean, that's kind of how viruses burn out. They become so contagious that everyone gets it and becomes immune. Right. So knock on wood, we might be close to the end of this, reaching herd immunity simply by infecting ourselves, not by vaccinating ourselves.
Yeah. But before we wrap up this segment, I want to get both of your thoughts on there's this debate in economics around inflation of, is it the perception of inflation coming that drives consumers, or is actual real inflation that then, hits the consumers afterwards? And I'm curious, John, if you're kind of seeing anything on that. Is this just as you said earlier, a fear that prices will be more expensive, or are people really feeling it now and trying to get ahead of it?
I think we're close to the tipping point where we move beyond just the fear to some of the reality, right? Yeah. I think up until this point, and that is evidenced by the way when we look at the question along political lines, because when you see that big of a disparity between Republicans and Democrats on their concerns for inflation, it's not because they've noticed it in their bank account. It's because they just fear it coming, and they fear that no one can fix it. But now that people are starting to spend and gas prices are going up, and they're looking at their monthly, personal balance sheets and noticing the difference. And especially now when they start spending this early on the holidays, they may start to feel that crunch. And I feel like we're kind of right at the crest of that, where it will become a more real thing. And that's not to say that a lot of Americans already don't feel those increased prices. If you're living on a really tight budget and your grocery prices are going up and your fuel prices are going up, but that has been softened a bit by the fact that the average U.S. consumer has just a lot more money, right? And they're making more money and they've saved more money and so on. So it's kind of like they haven't quite felt the pinch yet, the average consumer, but they're going to start feeling it if it doesn't get fixed.
Yeah.
John, let me ask you about Christmas shopping. So I'm using my wife and my mother.
I haven't started yet.
If they start shopping now in early October and they get everything they want, and the stores are still full come November and December, they're just going to buy more.
Oh, no doubt. I mean, that's what I'll
We
say
might
it
end up
again.
with like 4 times as many Christmas presents as we normally would.
I'm
Kids will
telling you
love
right
it.
now, it's another reason I'm expecting just like a crazy good holiday spending season,
Yeah.
because and we know this even in non-crazy years like this, where the earlier people start shopping for the holidays, the more they spend on the holiday, because they don't stop, right? They still go back to the mall and they buy more stuff than they plan to buy. Or now on the internet, it's like they see an ad for something and they buy it. So like, yeah, I think it's a really good sign that it's starting this early. It's not a great sign that it's being driven by fears of, shortages and supply chain and delivery delays and stuff. But the ultimate outcome is good for the retailers and certainly good for the economy.
Great. Well, this has been a fascinating conversation, but let's take a break. When we come back, Brendan, I want to get your thoughts on some earnings news this week, as well as what we're going to do with some of these Fed nominations. But you're listening to the HPS Macrocast. We'll be right back.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
We're back on the HPS Macrocast. I'm Brian DeAngelis with Hamilton Place Strategies, here with our co-host, as always, Brendan Walsh, Market Policy Partners. Brendan, great conversation with John. I always love having him on, and it's great to get the consumer perspective. I want to get your thoughts, though, too, on some other news this week. We'll jump into the Fed, but I want to start with earnings. Earnings season kicked off with the banks this week. From my view, seemed like they're doing pretty well. Tell us what you saw.
Yeah, definitely. So earnings season always kicks off with the banks. JP Morgan's always the first. Their CEO is a big personality, Jamie Dimon, so he always has good insight. He was actually fairly optimistic on the outlook for the economy, but we do have some bumps to go through. So banks have done very well, but a lot of it was on trading. So the Wall Street part of it. And they've also had massive reserve releases because of the pandemic. They put aside a lot of money for losses that they expect to come. But we had a huge fiscal and also monetary response to the pandemic. So those losses never happened, which is great. It actually works. It turns out if you hand people money, they don't default.
They'll use it.
They use it. But we have seen a little bit of NIM compression, but the banks also have run in the last 3 to 6 months as the market started pricing in the Fed potentially raising rates in the future. So some of the banks have gone down a little bit on earnings, but that's more a reality of they're up 30 to 50%. Goldman Sachs just blew out numbers. So
that's the thing. These are big numbers. Like JP Morgan crushed it. Goldman Sachs, we're talking.
Yeah, Goldman almost had double the expectation. They earned $14 a share, whereas they expected $8. But also a lot of that is trading and reserve releases, which are trading is a little more volatile, and reserve releases you don't really get credit for that. As an investor, you're happy it happened, but that's a one-time event. But we also have had some real world companies. United Healthcare, an insurer, it did quite well, and a lot of it was COVID related. People are getting lots of shots lately, especially with the second doses. And then Walgreens too has done really well. So the market trading into earnings season had been very much focused on macro, Fed, inflation, what's going to happen. Once earnings season came, it seems like it started on Tuesday or Wednesday, that the focus has now shifted to actual earnings, and earnings have been good, and the market has traded quite well in the last in the back half of the week. Today we're up a bunch today too. Yeah,
that's great. So to flip it around a little bit, so what does that mean for the Fed? The Fed is looking at inflation, there's the supply chain issues we talked about, and others. Like, they've kind of baked in the easing. I mean, I think as you guys have taught me over the years in this podcast, especially, like, they let you know what's going to be happening with sort of hints and nods for a long time. And we seem to be there.
And at the last meeting, that was it's less a debate over the immediate focus is them tapering their balance sheet. So they buy a bunch of treasuries and mortgage-backed securities. And that was to help, drive down rates, which can help seep into economic expansion. They are planning on decreasing those purchases. And at the meeting, they kind of telegraphed it that it's either going to happen in November or December. The minutes came out from that meeting, which gives you further clarity on what happened at that meeting. And they spelled that out. They said, we're going to start the taper process either in the November meeting or the December meeting. We think there's a chance that the market is basically baked in. It starts in November. I think there's a chance that it could happen in December because of uncertainty. The jobs number was weak, and you've had a lot of noise, and now you're kind of fierce. Yeah. But the inflation could push it. So it's a little more academic. I don't think the market is going to move hugely one way or the other, whether it happens in November or December. Then the market then would move to when they will start raising rates. Right. And Powell wants it in 2023. The market is starting to begin to kind of push it into maybe late 2022.
Yeah. Okay.
So that will be the focus there.
Yeah.
And I mean, going back to it, a lot of it has to do with inflation, but as a monetary policy stance, if inflation is going up because you can't hire people, raising rates actually exacerbates that situation. So it's a very unique scenario that we've never really happened other than in the 20s, which was an entirely different economy.
Brendan, which brings me to my favorite question that I have to ask you guys every time I guest host. Who's going to be in charge of all this? I think by just historic precedent, right? Biden has to make a decision here in the next few weeks. My money's on Powell. I know at times Brainerd's been a little bit of the front runner, and I know you guys kind of looked at that and had that thought for a while. What do you think is going to happen now?
Yeah, so I mean, our insight on Brainerd isn't like a DC insight. It's just kind of like, a Democrat is in charge of the White House, so they'll not.
And has a very loud Democrat in the Senate demanding
but,
it. Yeah.
By all indications, the Biden administration is very happy with Powell, and I don't know why they wouldn't be. I think that Brainerd's chances actually were probably hurt by Senator Warren's attack on Powell.
I think that's right.
Because Powell can be reappointed easily. He'll get 70, 75 votes in the Senate because Republicans like him. If you go with Warren, you're basically handing her the person that will be she gets to choose,
Right.
So if she doesn't like Brainerd, she can tank it because you need 50 votes. If you appoint a Democrat, it's going to be on party lines.
Yeah.
So you're
also guaranteeing
Warren that you get to choose.
Yeah. Which guarantees 50 Republicans oppose the person.
Right.
Yeah,
and I take also a step back when I look at the Biden administration. So the person they chose to run the OCC is a very, very liberal, very controversial pick. It almost seems like this is a trial balloon to show the party. It's so much easier to do Powell, and let's not have a self-inflicted wound here.
I think, we've talked about this a few times. I think if you watch what Biden has done on nominations in really the past year, it has been a nice mix of this, like a few going all the way back to Neera Tanden, right? Here's the person you want. Go try to get them through the Senate. And when they can't, he's also pairing it with here's the one that I know is going to make through, right?
Yeah.
I think you're right. I think OCC is okay, I'm all for it. like, it's going to be a street fight. You guys better be with me.
Yeah, good luck. Yeah.
And while you're fighting that one, I can't switch quarterbacks in the middle of where we are on the economy and Powell goes through.
Right, especially where now, I mean, the Build Back Better,
right?
I still think we do it, but I don't have a lot of faith in the Democratic Party. I think this might be a self-inflicted wound.
Yeah, and this is always the problem. You know, I was there for ACA, I was there for others. Like, it is going to be so ugly that it'll hurt us, right? And it probably gets through. It's probably in total, 2.5 trillion. I'm counting the hard infrastructure one there too. But,
the bipartisan one. Yeah, you're right. Yeah.
But, we limp into the election year just hating each other, and
I know.
With,
I mean, I think the midterm election could be a bloodbath.
It could.
The Senate's a little quirkier just
absolutely.
because of who's up, but the House, I don't see
it's not going to be
scenario where they keep the House.
But
I mean, they only have is it 2 or 3 seat?
3 right now. Yeah. But I'll come on another time. We'll go deep on politics and it'll be fun.
Yeah.
Before we wrap up,
it's also normal. Like a midterm election, that's what happens.
Yeah, that's history. Absolutely. Before we wrap up, what can we look forward to next week? Anything we should keep an eye on?
It's a relatively calm week. We get a bunch of purchasing managers index from around the globe. So Market, the company that does these surveys. So we both get services and manufacturing. So that'll give us an indication of what's going on in the world. But it's not massively market moving.
Yeah. Okay, great. All right.
Yeah. The big ones are retail sales, which you got today, the jobs number, and the inflation numbers.
Yeah.
And we've already got those for.
Okay. Great. Shall we leave it there?
Unless you've got some big news announcement you want to make.
No, I got to go get ready for the Red Sox. So that's
exactly.
Good. Let's leave it there.
Totally
great. Well, special thanks to John Dick. It's always a great conversation to have when he joins us. And thank you, Brendan, for co-hosting today with me. You're listening to the HPS Macrocast from Hamilton Place Strategies and Market Policy Partners. Everyone should have a great weekend, and we'll see you next week.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.